January 22nd, 2026. Stop scrolling for a second, because what's happening right now, this exact week, looks identical to August 1971. Not similar, identical. Gold prices stable, dollar confidence high, central banks coordinating smoothly, and then, 90 days later, the entire monetary architecture of the Western world collapsed. Or June 2007, credit markets functioning normally, liquidity everywhere, volatility dead, then Bear Stearns imploded, then Lehman, then the system. Most people never see this coming, not because they're stupid, because they're watching the wrong thing. They're watching price. They should be watching plumbing. And right now, in early 2026, the plumbing underneath the global monetary system is exhibiting the same structural rigidity, the same loss of flexibility, the same quiet disappearance of shock absorbers that preceded every major monetary regime change in the last century. This is the quiet nightmare phase. The phase where stability on the surface masks brittleness underneath. The phase where everyone feels safe, right before the structure can absorb one more shock. And the danger wasn't in the price, it was underneath it. If this walk through financial history sharpens how you see risk, liking the video quietly tells the system this work matters. Now let's go back, not to predict what happens next, but to understand the structure of what's already moving. Picture this. August 15th, 1971, Camp David. President Nixon, flanked by Treasury Secretary John Connally and Federal Reserve Chairman Arthur Burns, preparing to address the American people on live television. The Bretton Woods system, the architecture that had governed global money since World War II, was about to be suspended. Not reformed, not adjusted, suspended. Gold convertibility, the promise that every dollar could be exchanged for a 1/35th of an ounce of gold, was ending that night. And here's what matters. The decision felt inevitable to the people making it. Not reckless, not ideological. Inevitable. Because the plumbing had already failed. The promise had become structurally impossible to keep. Foreign central banks were draining U.S. gold reserves at a rate that would have emptied Fort Knox within 18 months. The choice wasn't whether to break the system. The choice was whether to break it now or wait until it broke on its own. So they broke it. And gold, which had been fixed at $35 per ounce for decades, began floating. Within 2 years, it hit $120. By 1980, it touched $850s, a 24x move in 9 years. Not because of panic, because the system underneath the price had fundamentally restructured. And if you're holding gold or silver right now, in early 2026, that story, that mechanism, is the only thing that matters. Because the question isn't, should I sell my gold? The question is, what does the plumbing tell me about when this monetary cycle ends? Let's go back further. 1944, Bretton Woods, New Hampshire. Representatives from 44 nations gathered to design the post-war monetary order. The goal is simple: stability. After 2 decades of competitive devaluations, currency wars, trade collapse, and global conflict, the world needed a system that could anchor value, facilitate trade, and prevent monetary chaos. So they built one. The US dollar would be pegged to gold at $35 per ounce. Every other currency would peg to the dollar. The US would guarantee convertibility, meaning foreign governments could exchange dollars for gold on demand. Brilliant in theory. And for 15 years, it worked. Global trade expanded, currencies stabilized, the post-war boom accelerated. But there was a structural assumption baked into the design. The US would run modest, manageable deficits. That assumption was never written down as a rule. It was implied. It was necessary. Because the system only worked if the supply of dollars grew slower than the global demand for dollars. And in the 1950s, that worked. But then the 1960s arrived. The Vietnam War, the Great Society programs, deficit spending that wasn't modest or manageable. The US began printing dollars faster than it accumulated gold. Foreign central banks, especially France, under Charles de Gaulle, began converting dollars into gold. By 1971, the US held $10 billion in gold reserves. Foreign governments held $80 billion in dollar claims. The math was impossible. The promise couldn't be kept. And here's the key. No one designed this to fail. The people who built Bretton Woods were intelligent, well-intentioned, experienced, but they built a system that worked only under conditions they couldn't guarantee. They assumed restraint, they got expansion, they assumed coordination, they got competition, they designed for stability and got rigidity. And once rigidity sets in, systems don't bend, they snap. Here's what happened between 1960 and 1971. Gold stayed at $35. Currencies stayed pegged, markets functioned. Everything looked fine. But underneath, the plumbing was tightening. U.S. gold reserves were falling. from $20 billion in 1957 to $10 billion by 1971. Dollar liabilities to foreign governments were rising from $20 billion to $80 billion, and critically, liquidity was disappearing. Because as foreign central banks converted more dollars into gold, the system lost its ability to absorb shocks. Think of it like this. A healthy financial system has buffers, excess reserves, flexible exchange rates, room to adjust. Bretton Woods had none of that by 1971. Every dollar printed created a claim against gold the U.S. didn't have. Every claim reduced flexibility. The system worked until it couldn't. And the most dangerous part? It kept working longer than it should have, because when systems appear stable, when prices stay calm, when institutions keep functioning, people assume the structure is sound. They confuse performance with capacity. And that confusion is what makes the breaking point so brutal. Pay attention to this part. By early 1971, the cracks were visible, if you knew where to look. In May, German and Swiss central banks stopped converting dollars into their currencies. They let their exchange rates float temporarily. In August, a congressional subcommittee report warned that U.S. gold reserves were inadequate to meet foreign claims. In private, Treasury officials were modeling scenarios where France, Germany, and Japan simultaneously demanded gold conversion. None of those scenarios ended well. The institutional blind spot wasn't ignorance, it was denial. Because acknowledging the problem meant acknowledging that the entire post-war monetary architecture was unsustainable, and no one wanted to be the person who said that out loud. So they didn't. They managed. They delayed. They hoped the pressure would ease. It didn't. And on August 13, 1971, the British government formally requested that the U.S. convert $3 billion in dollar reserves into gold. That was the moment. Not because $3 billion was large, but because it revealed that everyone was about to ask. If Britain asked, France would ask. If France asked, Germany would ask. And if they all asked at once, the U.S. would have to say, no. If you have a calculator nearby, open it. U.S. gold reserves in August 1971, 10 billion foreign dollar claims against those reserves. $80 billion divide $10 billion by $80 billion, 12.5%. The U.S. could have honored 12.5% of its promises. Not 50%, not 25%, 12.5%. The system wasn't bending. It was already broken. August 15th, 1971, Camp David. Nixon's advisors presented him with three options. Option 1, do nothing. Let foreign governments drain U.S. gold reserves until the vault is empty. Watch the dollar collapse in real time. Option 2, devalue the dollar against gold. Increase the price from $35 to $50 or $70 per ounce. Buy time, but signal weakness. Option 3, close the gold window entirely. Suspend convertibility. Let the dollar float. Nixon chose option 3. Not because it was radical, because it was the only choice left. That night, he went on television and announced, I have directed Secretary Connolly to suspend temporarily the convertibility of the dollar into gold. Temporarily. It's been 55 years. And here's what happened next. Gold, which had been fixed at $35, began trading freely. By 1972, $70. By 1974, $180. By 1980, $850. But the real story wasn't the price. The real story was the regime change. Because when the gold window closed, the entire global monetary system shifted from a commodity-backed structure to a fiat-based, central bank-managed framework. And that shift, that one decision, redefined what money was, who controlled it, and how power flowed through the global economy. Let's be precise about what happened. Who benefited? The United States. By breaking the gold link, the U.S. gained the ability to print dollars without constraint. The dollar remained the global reserve currency, but now it was backed by trust and military power, not gold. The Federal Reserve gained unprecedented monetary flexibility. Deficit spending became structurally easier. Who absorbed the cost? Foreign governments holding dollar reserves. Their savings were quietly devalued as the dollar fell against gold and other currencies. Savers everywhere. Because when money becomes untethered from a fixed anchor, inflation becomes the release valve for government debt. Between 1971 and 1980, U.S. inflation averaged over 8% per year. Gold holders, the ones who understood what was happening, saw their purchasing power multiply. Everyone else saw it erode. And here's the structural truth that never gets said. Monetary regime changes are wealth transfers, not market corrections, not cyclical downturns. Transfers of purchasing power from one class of holder to another. And the people who see it coming, who position before the break, don't just survive, they restructure their lives. Now let's come forward. January 2026. You're holding gold, you're holding silver, and you're asking, when should I sell? Here's the answer. Not yet. Not because I'm predicting higher prices. Not because I'm calling for dollar collapse. But because the structure underneath the current system is exhibiting the same loss of flexibility, the same depletion of shock absorbers, the same quiet rigidity that preceded 1971. Let me show you what I mean. U.S. national debt. Over $36 trillion. Annual interest expense. Over $1 trillion. Federal Reserve balance sheet. Still over $7 trillion after the most aggressive tightening cycle in 40 years. Global dollar-denominated debt, over $65 trillion. Now, pay attention. The system works as long as rates stay manageable. But if rates rise too fast, debt service becomes impossible. If rates fall too fast, inflation returns. The room to maneuver is gone. Central banks can't raise rates without breaking something. They can't cut rates without validating inflation. They can't print without destroying currency confidence. They can't tighten without triggering a debt crisis. This is structural rigidity. And just like 1971, the decision won't be whether to break the system. The decision will be whether to break it now or let it break on its own. And when that moment comes, when the plumbing finally fails, gold won't move 10%. It won't move 50%. It will reprice to reflect the new regime. Just like it did after 1971. Just like it did after 2008. So when should you sell your gold? Here's the framework. You sell gold when the monetary regime stabilizes, not when the price peaks, not when the headlines scream. Let me give you the markers. Sell when? 1. Central banks stop expanding their balance sheets permanently. 2. Government debt to GDP ratios begin multi-year declines. 3. Real interest rates turn positive and stay positive for 3+ years. 4. Currency volatility collapses and exchange rates stabilize. 5. A new monetary anchor emerges, whether that's gold, a basket of commodities, or a restructured dollar standard. Until then, prices are the headline. Plumbing is the story. And right now, the plumbing is telling you, this cycle isn't over. Here's what 1971 teaches. The break doesn't happen when prices collapse. The break happens when the system can no longer make the promise. Gold didn't surge in 1971 because investors panicked. It surged because the structural anchor, the convertibility guarantee, disappeared. And once that anchor is gone, price discovery begins. Not speculation. Discovery. Because markets have to figure out what gold is worth in a world where dollars are no longer scarce, no longer constrained, no longer backed by anything except the credibility of the institution printing them. And that repricing process doesn't take weeks. It takes years. In 1971 to 1980, 9 years. 2000 to 2011, 11 years. If we're in the early stages of a similar regime transition, and the plumbing strongly suggests we are, then selling gold in 2026 would be like selling in 1973. Technically profitable, structurally early. There's one more thing. The risk you're not thinking about. Confiscation. In 1933, President Franklin Roosevelt signed Executive Order 6102, which required U.S. citizens to surrender their gold to the Federal Reserve in exchange for $20.67 per ounce. Then, once the government held the gold, they revalued it to $35 per ounce, a 69% wealth transfer by decree. Could that happen again? Legally? Yes. Politically? Harder now than in 1933, but here's the key. Governments don't confiscate gold when they're strong. They confiscate it when they're desperate. And desperation comes when the plumbing breaks, when debt becomes unserviceable, when inflation becomes structural, when trust in the currency erodes. So if you're holding physical gold, you need to understand. The exit isn't just about price. It's about timing the regime change and getting out before the rules change. Let's talk about silver for 90 seconds. Because silver is not gold. It's the leverage play on the same monetary breakdown. Gold is money. Silver is industrial commodity that remembers it used to be money. And that distinction matters. Because when monetary regimes shift, gold reprices based on monetary demand. Silver reprices based on monetary demand and industrial scarcity. In 1971, gold went from $35 to $850. Silver went from $1.30 to $50. Gold 24x. Silver 38x. But silver is more volatile, it falls harder, it rises faster, and if you're holding it, the exit timing is tighter. Because silver will peak before gold does, just like it did in 1980, just like it did in 2011. So the framework is, sell silver when gold-to-silver ratio compresses below 30. Sell gold when the regime stabilizes. Let me leave you with two things. First, Monetary systems don't collapse because of bad decisions. They collapse because the structure can no longer support the promises. And once that happens, the regime changes, power shifts, wealth transfers. And the people who see it coming don't panic at the wing. They reposition. Second, the human instinct is to sell when you're scared and hold when you're comfortable. But regime changes reward the opposite. You hold through the fear, you sell into the stability, because the danger isn't in the volatility, the danger's in the rigidity. History doesn't repeat events, it repeats incentives. And right now, the incentives driving global central banks, sovereign debt structures, and currency management are identical to the incentives that broke Bretton Woods. Not similar, identical. So when should you sell your gold and silver? When the plumbing tells you the cycle is over, not before. If this helped you see the system more clearly, consider liking this video and subscribing to the channel. Not for predictions, but for perspective.